Okay, hi everyone. This is going to be the video for the problems for chapter 2. So it looks like we have some multiple choice questions, 10 of them, and then a couple exercises we're going to be doing. So looking at the multiple choice, if we're going to start with that, it says if a publicly traded company is trying to maximize its perceived value to external users, it's most likely to understate which of the following. This one's going to be D, your liabilities. In other words, imagine you were on Shark Tank, right? And there were the sharks, the external users. You're going to tell them about all the good stuff about your business. Like, we have tons of assets, we have a lot of retained earnings. You would then minimize. You can't fully hide, but it's like anything, right? You're gonna put your best foot forward. If you had to minimize something or reveal it only upon being asked, that might be something like your liabilities if you owe a lot of money. So 2 here, which of the following is not an asset? This is going to be D, APIC. Right? In other words, investments are an asset, that's a thing you own. Land are, and so are prepaid expenses. Right? Remember we said if you pay your Netflix a year in advance, that's actually an asset, a prepaid asset or a prepaid expense. And then every month as you use it, you take the expense pro rata. APIC in distinction, that's going to be a stockholder's equity account. Right? Remember we said your stockholders' equity has your common stock and your retained earnings. And then you break out your common stock again between the formal common stock account and your APIC account. 3 here. This is a good one to read the last part of the sentence first or the question first. So they want to know, what are the total amount of assets that would be on the balance sheet? Right, so we know our assets equal our liabilities plus our stockholders' equity. So they want this right here. Now, it looks like our total liabilities are $150,000 from the facts. Our ending retained earnings is $80,000. Our net income is $60,000. Common stock is $40,000. APIC is 20. So in this case, right, it's going to equal our assets to make that balance 290. A in this case. Now, one of the things here we didn't use, right, is this net income, right, the $60,000. Now, why didn't we use that? 2 reasons, right? Net income is on the income statement, and 2, net income is already a part of retained earnings. In other words, this $80,000, this retained earnings right here, it would be comprised of your beginning retained earnings plus your net income minus your dividends gives you your ending. So in other words, in this $80,000 already is the net income. It's your beginning plus your net income minus your dividends equals your ending. So your ending here, 80, would go over, and that would already include your net income. So if it's already included in here, and then you were to put it down there, you'd be double counting it, right? 4 here, the dual effects concept can best be described as, this is going to be A, right? When you do a journal entry, basically your total debits are going to have to equal your total credits. You have to keep that fundamental accounting equation in balance. 5, it says the T account is a tool commonly used for analyzing which of the following. Now this is going to be D, it's all of the above, but in order to make sense of that, right, let's look here at an actual T account. Right, so 7 is doing exactly that. So 7, they're saying, hey, you have a cash T account, which is an asset, right? Our debits are on the left, right? Our credits are on the right, so that means plus, minus. And then normally the natural balance, wherever the plus is, that means there's going to be a beginning on that side, an ending on that side. So 7 here, if we look at it, it says, hey, cash T account has a beginning balance, 21,000. During the year, it was debited, right? Debit on the left here, 100,000. And then it was credited 110, right? They want to then know what is our ending balance for cash. Okay, so this is going to be our beginning plus, right, all the pluses on the left, minus, the minuses on the right, our ending in this case. So it's going to be an 11,000 debit balance, A. So if we go back up to 5, right, the T account, why is it all of the above? Well, yeah, it shows increases and decreases to a single account right there. It shows debits and credits to a single account. And then it shows changes in the account balance. So we went from 21, we ended at 11. It shows that change, right? Now these middle guys in the T account right here, these come from the general journal, where we do all our journal entries. So every time you do a journal entry, populate it over into the T account. We'll look at that when we do the exercise together. 8, it says, which of the following statements are true regarding the balance sheet? So this one's going to be D, all of the above, all of them are true. The first one here, it says one can't determine the true fair market value of a company by reviewing the balance sheet. So what that means is, right, if you were to pick up a balance sheet, you wouldn't be able to see what the company was currently worth, the current fair market value. It goes back to when we used that like toilet paper example where you bought it for maybe $100, but then now it's worth $500. We said GAAP requires balance sheets to be prepared using the historical cost principle. So for that reason, when you picked up a balance sheet, you would see toilet paper for like $100, right? What we paid for it, not currently what it's worth, namely its fair market value. 2, certain internally generated assets, for example, trademarks, are not reported on the balance sheet. That's true. We'll learn about that at a later point in time in this course. And then 3, essentially it's saying here, a balance sheet is prepared at a point in time. That's true, right? So D here, all of the above are true. If we look at 9, we read the last part of the question first. It says, what is the current ratio for this company? Okay, so we know the current ratio is going to equal our current assets divided by our current liabilities. So when we read through these facts, we just have to kind of pluck these items out. So hey, it says at the end of a recent year, the company had total assets of 13 million, current assets of 4516, that's what we care about, current, total liabilities of 10 million, current liabilities of 3209. There we go. We kind of filtered that to the appropriate numbers we needed. So we would do our current assets divided by our current liabilities. We're at 1.41 then. It's going to take us to B right here for the answer. Now, why it's not D, in other words, why D is incorrect, yeah, it does say 1.41, but then afterwards it suggests that the company is not able to pay its short-term obligations. The current ratio is actually the reverse item. In other words, the current ratio is showing you that you are able to pay your current liabilities. So that's why that one is incorrect. 10 here. It says, which of the following is not a financing activity on the statement of cash flows? So this one is going to be A. We'll talk about this in a later chapter, more detailed information about the statement of cash flows. In short, right, you have your inflows and your outflows that each time you categorize it is to an operating, investing, or financing. When you have financing, right, this deals with like stockholders and creditors, right? How do you get the money to finance your operations. So anytime you have transactions with cash that involve those two items, they're going to be financing. So that's why, borrowing money from a creditor, if you pay dividends to your stockholders or you issue shares, things like lending money, that might be more an operating activity. So again, we'll look at this in a later chapter. Now, the next one we're going to do here, we're going to move to E29, right? And I've built this out a little bit to save some time for us here. But if we were to look at this, right, basically what I have here is a little cheat sheet, as I would call it, right? A little summary that's going to help us to understand what we're doing here. So if you remember in the PowerPoint, take a drink of water here real quick. If you remember the PowerPoint, right, we said there's the circle of accounting, right, where it happens every period, the same thing. And we start with our general journal, then we do our general ledger. We'll then prepare a trial balance. And finally, from that, we'll prepare our financial statements. There are some intervening steps we're going to build upon this, but for right now, this is where we stand. We're building our way up. Now, the general journal is chronological. In other words, we just do the journal entries as they happen. 1, 2, 3, 4, as they happen throughout the year. Then afterwards, we have our general ledger, which is the T accounts, right? We have all these T accounts, and essentially what we do is every time we have a journal entry, we populate one of the T accounts, right? And then when we finish all of the T accounts, right, we're done with all of that, we would use the ending balance, like the bottom number in the T account, and transfer that over to make a trial balance, right? And the trial balance is basically one giant T account, for which when we use the ending balances in there, we can prepare the balance sheet, okay? So this is like a little cheat sheet for what we're going to be doing here. A general journal, a general ledger, a trial balance, a balance sheet. Now the first two here, we're going to kind of consolidate one into another to show you what's going on with it. So with that being the case, what we're doing, let me explain some of the facts because I've modified this example. So let's imagine we're looking at a company, right? And here we are, we're at the end of year 3, right? And during year 3, all of these transactions happened, okay? Now, if we backstep a little bit here, we're at the end of year 3. Stuff happened during the year that we have to do journal entries for. But another important piece of information here is we have years 2 balance sheet, or just accounts, right? And the idea with it is, if you remember, right, last year's ending is this year's beginning balance. In other words, at the end of year 2, that is to say our balances from our balance sheet, are going to be this year's, year 3's, beginning balances. So if we have all these T accounts over here, right, I built out a general journal and a general ledger. Right, here's the T accounts. This will make more sense as we go through. What we're first going to do is carry over last year's ending to this year's beginning. Right, now in practice, this is automatically going to happen. It's going to roll forward automatically. Now this is going to be 0 because this arises from a transaction that happens during the current year. Oh, see, I made a mistake there. I tried to put it on the left. Liabilities, right, because the positive is on the right, it's going to be beginning and ending on the right as well. So we got to make sure that we follow that. Our note payables are that amount. This guy also is a 0 that relates to these two. We'll see it. It didn't, because it happened this year, it didn't exist last year, so it's not on last year's balance sheet. Our common stock, we can just nab from up here, and same with our APIC, right? So we're just teeing this up a little bit to see what it would be like in practice. So imagine that at the end of the last year, this is where we stood. Our ending balances are this year's beginning. And then during the year, right, these events happen. So let's look at this now at the general journal and do some journal entries. So for A, right, let me just take a second here. So for A, right, if we were to write this out, it looks like we received $70,000 cash from 6 investors. Each investor, so there's 6 of them, received 8,400 shares, common stock with a par value of 10 cents per share. Okay, so what we did here in A is we sold stock for cash, right? And if we were to do the journal entry for this, we'd have step 1, step 2, and step 3. Right, so step 1, we have to identify cash, common stock, and then remember we said we have APIC as well every time you sell stock or issue stock. Cash is an asset, it increased. Common stock is a stockholder's equity account, we now have more of it, it's increased. Likewise with APIC. Now what you do is you just follow the little key, right? Asset plus, debit it. We're gonna debit cash in this case for 70,000. Then we're going to credit common stock and credit APIC. Now, the idea here for common stock, this is a little tricky, right? We have to think about this. It's going to be 8,400 shares that each investor receives. So there's 6 of them. So we got to do 6 times 8,400 times the par value. Okay, so equals 6 times 8,400 times the par value. So it's basically always the total number of shares you issued. So 6 people, each of them got 8,400 with a 10-cent par value equals 50/40, which then means if we do the 70 minus the 50/40, we're going to have 64,960. In other words, we can plug this APIC right here. Now what we're going to do, right, with this, when we do a transaction in the general journal, then we're going to carry it over here to the general ledger, right? So we had a debit of cash for 70. I built this out already for you. We're going to have credit the common stock for 50/40. Credit the APIC, right? Let's look at B here. So B says signed a 5-year lease for $150,000 for the right to use a building each year. So this one's a little bit tricky with it. So basically signed lease for exclusive use of building, right? And what you're gonna have here for it, you're gonna have 2 accounts, right? It's gonna be the operating right of use for the asset, for the building, and then it's going to be this long-term lease liability. So what does this mean, operating right use of the asset? In other words, you have the exclusive use for the building for the next 5 years. That's an asset, something you own. So it's an asset that's increased. You have a long-term lease liability that's increased. So if we follow the key right, asset plus, you're going to debit that operating right for, let's see how much it was for, 150,000, right? Then you're going to credit the long-term lease liability for 150,000, right? So then we're going to just carry these over, right? So let's find that operating right. We have to debit it there, right? And then we have to do our Long-term lease liability is a credit, right? We took care of it. Now let's look at C, right? C says we purchased equipment for use in the business. It cost 18 grand. Looks like a fourth of that we paid cash and the rest was a note. Okay, so we bought equipment, 1/4 cash, and 3/4 note that we signed to pay back. Okay, so in this case, right, we have equipment, cash, and note payable that we got to pay back. Equipment's an asset that we now have more of, right? Cash is an asset that we now have more of. Or I'm sorry, cash is an asset we now have less of, right? We paid cash here. And then note payable is a liability that we now have more of. So if we were to do the journal entry, right, it would be debit equipment in this case for, let's see how much we paid. It looks like it was $18,000, right? And we're going to credit cash, credit note payable. Cash, now again, they don't give us the numbers here. We have to kind of back into this. Cash is going to be the 18,000 times 1/4, right? 4,500. Now we could plug this note payable to make it balance, right? You could do 18,000 minus the 4,500. That's great. Or you could do the 18,000 times 3/4. Get you to the same spot, right? Let's carry these over now. And if you're following along and you're trying to do this, that's great. You'll work with me here. This is a video, so I'm very familiar with this, and if I'm going at a pace faster than you can keep up, that's fine, right? That's really natural and normal. Just pause the video, rewind it. We can get through this. I try to go reasonably paced here, but with this, right, we would debit our equipment, right, for 18,000. We would credit our cash for 4,500. We would credit our note payable for 13,500. Okay. Let's look at D. Looks like we signed an agreement with a cleaning service to pay $120 per week for cleaning corporate offices next year. This one is going to be no transaction. It's kind of a trick, right? And the reason for this is it deals with a future event. Remember we said transactions are really past looking. It's looking at things that have already happened, not what are going to happen. So for this reason, there's no transaction. E here, it looks like we received an additional contribution from investors. They gave us $3 grand in cash and 15 grand in land for 1,000 shares of stock. Okay, so it looks like we sold stock for cash and land. Okay. Now with this, right, our accounts, looks like we have common stock, APIC, cash, and land, right? Common stock is stockholders' equity. We now have more of it. Same with APIC. In other words, when you issue shares, there's now more shares floating around out there. They've increased. Likewise, we sold them for cash. We now have more cash. We now have more land, right? So when we do the journal entry, we have to do our debits first, right? So like our asset pluses here, that's a debit. So they would come first. So we would do debit cash, debit land, credit common stock, credit APIC. And for the amounts here, let's look and see the numbers in E. So it looks like 3 in cash, 15 in land. So 3,000, 15,000. Then there were 1,000 shares. Okay, so we're going to do equal to 1,000 shares times the 10-cent par value per share gets us 100. So we know, right, if our debits are 18,000, we'd have to just back out that 100 to make our total debits equal our total credits. We could just plug that APIC. So let's carry this over now, right? We got to do our cash, 3,000, our land, a debit, 15. We have common stock over here for 100. We have APIC of 17.9. Okay. Let's look at F. F says we lent $2,500 to someone who signed a note due in 6 months. So basically we lent money and got a note receivable, right? Now the person we lent money to, that is to say the borrower, they have a note payable. We, in distinction, have a note receivable, right? So we have cash, a note receivable. Cash is an asset. It went down, right? We have less cash. Note receivable is an asset. It went up, right? So we're going to debit note receivable for 2,500. We're going to credit cash for 2,500. And we can carry this over, right? So I'm going to put the 2,500 here for cash. We could have added an extra line. It's not going to be a big deal here. Debit note receivable. Okay. And then G, it says it looks like one of the owners, they borrowed $7,000 for personal use. Now this means because it was personal use, there's no transaction here. In other words, we only care about what the business does, right? That's separate entity assumption. We're not as concerned with what the actual owners are doing in their personal time with their personal uses here. So for this reason, right, we're not going to have a journal entry for this. So with that being said, right, we've done the general journal. Cross that off. Now we have to kind of finalize this general ledger over here, right? We got our beginning balances from that balance sheet, and then the middle stuff we populated from the journal entries. So what we're going to do here, right, is just add them up. So we'll have that plus that, right, because the plus is on that side. Looking at our liability, right, it's going to be this plus, right, because it's on the right there, 38.5. So you can see the general rule is you just follow the pluses. With cash, it's a little different. You're going to do your beginning plus your, plus signs there. And then minus over here, right, your credits. Let me just double check that because it was in the road there. So add all these together because they're on the plus. And then subtract those. Oh, we got a different number there. So let's see what's going on here. Let's try this one more time. Let's see what it's saying. So we got equals our beginning plus our additions minus our subtractions. 76. So let's do our beginning. See, the problem is the way this is coded, it's hard to see. Okay, there we go, 76,000. All right, and you could use a formula here for the simple ones, right? You could just sum up the sides. Another way you could do this, right, for cash, that you could just copy this formula all the way through is, right, equals the sum of this minus the sum of that column. 76, right? You could just copy and paste that formula through for your assets. If, however, you were doing your liabilities, right, you'd have to do the sum of this column minus the sum of that column, 38.5. So I'm just copying and pasting the formula. So here's the idea, right? We had our beginning balances for these guys. They came from last year's ending, last year's balance sheet. We have our middle stuff for all of them, right? They came from the general journal, right? From those transactions. And then we have our ending balances here once you kind of see how it flows down. Now what we have to do is, right, we will have to carry these over again, right? So in this case, for purposes of our trial balance, we have a debit of 76, 14.5, 33, 16, 150. Here we got to flip over, right? It's a credit over there. 38.5, 150, 61.40, 94, 860. Right, I'll give you a few seconds to look at that there. Again, where are we getting it? It's just the ending balances from over there. And also, we can go over, and put the little X there, and let's put the little X above the trial balance just because we're almost done with it, right? So you can pause this or you can look at it, but that's how we got it, right? So then what we're going to do, we're going to want to sum these columns, right? So just in other words, when we say sum, that equation, we mean equals, like the total, add them all together, right? So 289.5, 289.5, that's a good sign, right? They equal each other. You want that to happen in your trial balance, right? Now what we're gonna do, right, I'm trying to save us some time by populating this all out. We're gonna carry these balances over here, right? So cash is gonna equal, not the arrow, 76, 14.5, equipment, 16, our notes, looks like we have to add this operating lease, right? And that might be further up. We list these in order of liquidity, but for purposes of this, let's just put them on here the way they've kind of flown over with it. Great, so what we did is we just had these come over. So we're going to have our total assets, right, which is the sum of all of these guys. We're going to have our total liabilities, and our total stockholders' equity. So this is going to be the sum of those two, and the sum of these two, right? I just copied the formula from over here and pasted it. I held Control, hit C, and then over here I held Control and I hit V. If you're wondering how you copy and paste a formula. You do have to be careful with that because it will follow the same ordering rules as the other one. So I'll leave that for your technology class. Be aware that Excel is an important tool as an accountant. So total assets plus stockholders' equity, that's going to be 188 plus 108. Hey, our balance sheet balances, right? If we were to add the little There it goes, right? And we can put the X there. So what I'm going to do is a little panorama here to show you everything we did, right? So here's the general journal, what we did, right? We just did the journal entries as they happen, right? 1, 2, 3, 4, 5. Then whenever we did the journal entry, right, we carried the balance over. We debit cash there, we carry it over here. Credit common stock here, credit it over here, right? So every time we did this, we carried it over. Then what we did is we followed the ending balances. We found these out by just, summing the totals in light of the positive and minuses, right, to get our ending balances here. When we got our ending balances over here, right, we then carried them over to our trial balance, basically a big T account where our total debits have to equal our total credits. From that, we took the ending balances in the trial balance and we populated them into a balance sheet. Now, the homework, right, the exams, they're going to be more like one-shot type questions in the sense that I could give you one journal entry, or I'll test you on a T account, right? Like I'll give you a beginning and an ending balance and I'll make you solve for the middle or something, right? This is just showing us the big picture, how it kind of all comes together. But, logistically, I can't ask you, there's not enough time on an exam. This was a pre-prepared problem that's teed up and everything's there. There's just not enough time on an exam to have you literally prepare all of these things. So let's look here at E22, right? Another exercise. They're giving us A through M here, right? And they want to know what we're really working on here is step 1 of that journal entry, right? So step 1, if we go back here, that's where we just identified the accounts that were in play. So here's step 1. They want to know what are the 2 accounts in play. In other words, what did you receive and what did you give? Now, let me kind of preface this by saying that sometimes you didn't give anything, sometimes you didn't receive anything. In other words, it doesn't fit cleanly into this idea of receive and give. This works for 90% of them. But if we look at A here, right, it says a new company is formed and it sells 100 shares of a par value stock for $12 per share to investors. Well, what did we receive? Cash, an asset. What did we give? Common stock and APIC, stockholder equity accounts. We saw transactions like that in the E29. B here, it says a company purchases for cash a new delivery truck. Okay, so what did we receive? It looks like we got a truck. What did we give? Cash. Okay, not too bad there. C, it looks like a woman's clothing retailer ordered 30 new display stands for future delivery. This one can be a trick, right? It's not actually a transaction here because it's for future delivery. Continuing, if we look at D, all right, D here, it says a company orders and receives 10 personal computers for office use, for which it signs a note promising to pay $25,000. Okay, so D, what did we receive? Computers or equipment. What did we give? Well, in this case, right, we had a note payable, right? We're going to owe them money. It's kind of like we gave them cash, but it's delayed, right? That's why it's a note payable. Again, I said some of these don't cleanly fit into this receive and give idea. E, it says a construction company signed a contract to build a warehouse. Okay. At the signing, it writes a check for $50,000 to the construction company, the corporation who's doing it, as initial payment. answer from the standpoint of the corporation, so the people who paid the money for this. So this one's, I hate when they do this stuff where it's like, they start with one party, then they go to another and they ask a question about the other. It's like not reading it right. This one is a little bit tricky. It's more of an advanced accounting course. So like the account is called construction in progress. That's what they're receiving, right? They're building something, they're working towards it. And, the other idea here is going to be cash, what you gave up. So don't worry about that one. I don't know why they, one thing you will see with accounting, especially if you look at the optional multiple choice problems, they will start asking stuff or like testing items before you even learn it or see it. So I don't like that they do that. I don't think that's like really a fair thing to do. So that's why I always try to be like fair and reasonable for exam questions and homework. If we don't learn it or it's not somewhere in the chapter, they shouldn't be asking about it. That's just my opinion. But I don't make all of these exercises. I just teach them. I'm just the teacher here, right? So let's look at F. It says a publishing firm purchases for cash an intangible asset. Okay, what did they receive? An intangible. What did they give? Cash. G here. Looks like a firm declares $100,000 dividend to be distributed to stockholders next period. So this one is one of those that doesn't really cleanly fit into it. So what was given is retained earnings. What was received was a reduction in retained earnings. And what was given is a dividend payable. So let me kind of explain this here, right? This one's a little bit wonky, right? When we were to do this, they declare a dividend. First off, they're like affirmatively doing it happened in the past, right? They declared it, they're on the hook for it, so it's going to be a transaction. What you do is you debit retained earnings and you credit dividend payable. That would be the journal entry. Now, my first point here is that dividends themselves are only on the statement of owner's equity in retained earnings, right? Beginning plus net income minus dividends. Dividends payable, however, it says payable, that's a liability on the balance sheet. So pure dividends, right? You're not going to see them as an expense on the income statement. They're just going to be in the retained earnings roll forward. And then dividends payable, liability on the balance sheet. So here when you declare it, right, if we remember retained earnings, it's beginning plus net income minus dividend equals ending retained earnings. Right, so let's imagine it was $100. Let's say we had 25 of net income. We had 10 of dividends, so our ending is going to be 100 plus that minus that, right? 115. Okay, here's the idea, right? This is ending retained. If you were to increase this dividend, why isn't that showing here? In other words, if you were to make this go up, right, 15, so if we were to do beginning plus net income minus a bigger dividend, right, it makes retained earnings go down. So increasing dividends makes decreasing retained earnings. That's why we're debiting retained earnings here, right? It's retained earnings is stockholders' equity account. So if we go over here, right, it goes down. It's subtraction through a debit, right? So this is what happens when we declare the dividend. And then later on when we actually pay it, we're going to do debit dividend payable, credit cash. Right, so that's the idea with this, what's going on. Just wanted to give you a little bit of background on that one. If we look at H here, right? It says a company purchases a piece of land for $50,000 cash. Okay, so what did we receive? Land. What did we give up? Cash. If we look here at I. Okay, so I here, looks like a manufacturing company acquires the patent and intangible asset. They paid cash and signed a note payable. Okay, so I, what did they, in this case, if we're looking at it, oops, what did they receive? Well, in that case, they received an intangible. What did they give? Right, they gave cash and a note payable, right? J here, if we look at J, it says a local company is a sole proprietorship. Its owner buys a car for personal use. We've already seen this, right? Personal use is no transaction. We don't care about what people do in their personal lives. K, company purchases 100 share of Apple common stock as an investment. Okay, so if you ever see the word stock, it doesn't always mean our stock. Sometimes we're buying other companies' stock. So in that case, right, we received an investment and we paid cash. L here, company borrows $1,000 from a bank and signs a note. So what did we receive? Cash. What's the other account? We have a note payable. Then M, it says the company pays $1,500 principal on its note payable. Okay, so it just pays off some of that note payable. So what does it receive? Well, a reduction in its note payable, right? It would be like if you paid off your credit card, the balance went down. What did they give? Cash. So again, you can look at that there if you want to pause it to write those down. The last item here we're going to look at with this, just some definitions, right? Should probably take 5-10 minutes here. Zoom out, get the drawing tool. So transaction, right? This is going to be E. Right, an exchange between an entity and one or an external party. Going concern, right? This is going to be F. Concept that a business will operate into the foreseeable future, right? We talked about that assumption. Balance sheet for 3. This is going to be B. It shows our assets, liabilities, and stockholders' equity. Okay, 4 is liabilities. This one here is going to be P, measuring obligation. So this is the fancy GAAP definition down here, right? We said liabilities are really things you owe. 5 here, this is going to be K, right? That's the fundamental accounting equation. Our assets equal our liabilities plus our stockholders' equity. Okay, 6, note payables. This one's going to be M. So it's an account that's credited when money is borrowed from a bank. 7, common stock. This is going to be L. Basically the shares issued at par value. 8, the historical cost principle. It's going to be H. This one basically says, hey, we record things at cost. We put them on the balance sheet at what we paid for them. When we do the journal entries, we do it for what we paid for the item. 9, account. This is going to be I. It's basically a standard format we use for the different accounts and items. Cash, account receivable, payable. All those accounts we have T accounts for as well. 10, dual effects. This one's going to be Q. So basically every transaction when you do the journal entry, your total debits have to equal your total credits. 11, retained earnings. This one's going to be O, right? So this is going to be the cumulative earnings of a company that aren't distributed to owners, right? That's what we basically said, hey, retained earnings are those earnings that you keep or retain within the business. 12, current assets. This one's going to be A. So if we scroll up here, right, current assets, these are going to be economic resources, basically that 1 year mark assets that we're going to use within the next year. Separate entity assumption, we've seen this a couple times today. This is going to be C here. So let's cross that off, and it said business transactions are accounted for separately from the transactions of the owners. Like, when the guy bought the car for his personal use, we don't care about that as accountants, right? That's a personal thing separate from the business. We're not going to do a journal entry for it. 14, par value. This one's going to be X. So if we look at X, a legal amount per share, right? It's that like de minimis value. You have to have it because the law states you do. It's like a minimum value. 15 for debits. This is going to be D. One of the things I keep seeing here, right? D for debits. What are the other ones I saw? H for historical cost principle. B for balance sheet. Somebody's probably laughing, whoever made this thing. They're giving them away with the first letter. D for debits. This is going to be an increase assets and decrease liabilities, right? So if we were have a debit and you have an asset, right, it's a plus. So that's why here it's they increase assets. And for liabilities and stockholders' equity, right, it's the reverse. It's minus plus. I'm sorry, let me flip that out here. I was doing minus plus, but I was doing it in the wrong order. Minus plus debits there are going to be subtractions, right? So for liabilities and stockholders' equity, it decreases at minus. 16, if we look at this, accounts receivable, this one's going to be J, amounts owed from customers. So that's an asset. Somebody owes you money at a later point in time. Remember we said a few tricks to remember here, kind of summary items. Receivables are assets. Payables are liabilities. I'm not spelling any of these words right. This is an accounting class. It's not an English class. And then a few of the tricky type of accounts. Prepaid expenses. These are assets, even though it says the word asset. Unearned revenue, right? That's a liability, even though they say revenue. What are some of the others? Costs of goods sold and cost of sales. That's going to be an expense on there, right? So these type of things, they're not super intuitive right off the bat, so I try to call your attention to them with a tricky type of accounts. But if you remember these things, receivables are assets, payables are liabilities, and then these sort of nuanced exceptions, that'll go a long way for you. 17 here, monetary unit assumption. This one's going to be N, right? It just basically says accounting information should be measured and reported in a monetary unit standard without, adjusting it for inflation. So in other words, hey, we assume and we should use, the national monetary unit to express the health of the company. 18 here, stockholders' equity. This one is going to be R. It's going to be financing provided by owners and by business operations. So in other words, financing, when we say, if somebody comes up to you and says like, hey, how do you, like, or if you go to buy a car, right, and they're going to say, how are you going to finance this? Basically means, how are you going to get the money to get this car, right? With stockholders' equity, right, that's the financing. In other words, what we get from our stockholders, or we get from people who loan us money that we use to run the business, or if we get the money to run the business internally from our retained earnings. So there's the answers there. You can look at them, right? I think, yeah, we use this A. Let's cross that off. So this one, if the other one was debits, this one, let's see if it's credits, right? A credit would decrease an asset and increase a liability, right? So G here, this is credits. S, the concept to exercise care not to overstate assets and revenues. This is probably conservatism. The idea is when you're doing accounting, you want to be conservative, basically not take unnecessary risks. Useful information has predictive and feedback value. So we talked a little bit about useful information, right? We said it has to be relevant and faithfully represented. You hear relatively small amounts, not likely to influence the decisions. That's going to be like kind of a relevancy concept. If it's like so small, we're not going to care about it. It's not going to be relevant. It would be like immaterial. And then the next one here is measurable economic resources expected to be used or turned into cash beyond the next 12 months. So those would be non-current assets. And then W, where it says useful information should be complete, neutral, and free from error. This is really just saying that, hey, it should be faithfully represented and accurate, right? We don't want issues and errors with it. So with this, I'm going to end the lecture here for the problems. Like I said, these like being videos, the good thing with it is you're able to pause, right? So you can stop, rewatch it. In class, this lecture might go a little bit longer because maybe people are doing it by hand, or we don't have that luxury of doing it where you can pause the video and just write everything out, right? So with all of that, right, this will end chapter 2. We'll see you in the beginning of chapter 3. So thank you very much. We'll see you soon.